Hello, people. You're here with Sean Brooks, the realtor from eXp Realty. And I wanted to create something special for this occasion. Many buyers right now are confused about what's going on in the marketplace, and some are making a decision to hold off. And I will show you the reason why you shouldn't do this. And I'll review to you when people have done this in the past. It didn't work out the way they thought it would work out. And I'll give you an example. Before the pandemic really got rolling, I had a buyer. They were already pre-approved, ready to go. We were looking at houses. We had one in the process that was in negotiations, and they could have actually purchased the home. They got wet feet, and they said, "Well, we're gonna wait and save up some money." And I was trying to explain why that doesn't work. If the interest rates go up, it wipes away that buying power and the ability to actually purchase. Um, they wanted to do it anyway. Rates went up from 3% to 4 to 5, and it wiped away that strategy. So today I want to show you the reason why you should purchase, and I'll explain to you what's going on. All right. So let's go through the process. All right, next slide. Breaking news. The rates went up and the world is ending. All right, the reason why I use that slide is to bring some light to the situation. The rates all throughout history, I mean, rates from 3 to 16% people have purchased homes. I want you to understand that. I want you to understand why the media wants you to stop. And I'm going to show you something on the next slide where it kind of breaks down what's really going on in the marketplace. All right. So there's a study that was done by the National Association of Realtors on the impact of institutional buyers on home sales and single family rentals. The reason why this was being done was in the key findings, they tracked institutional buyers made up 13% of the residential sales market in 2021. With the median purchase price of institutional buyers typically 26% lower than the state's median purchase price. So they were offering less money to purchase those homes because it was cash offers. All right, so we defined institutional buyers as companies, corporations, and LLCs. These are individuals that's using cash or some sort of investment strategy to buy homes. And we found that institutional buyers purchased 13.2% of the residential properties in 2021, up from 11.8 in 2020. So as you see, pandemic going on, they were buying more houses. These buyers was causing the prices to go up because it was cash buyers. They're quick. They register as a sale in the marketplace because it is a sale. Now, if you exclude that data outside of the data of people buying houses to live in, right, the data is a little bit different. All right, what does interest rates increases affect? Okay, so let's talk about the overall Federal Reserve and them upping the interest rates. So the Federal Reserve sets borrowing costs for short-term loans. I want you to pay attention, short-term loans in the US by moving its federal funds rate. All right, the Fed kept this rate near zero during the corona pandemic. The reason why they had to, we're going to go into a recession with all the jobs shut down, people couldn't work, people staying at home, only essential businesses being open. It could have sent the country into a recession. So they kept it near zero. They gave away some pandemic relief to keep everything moving. The rates, right? The rates govern how much banks pay each other in interest to borrow funds from their reserve, kept by the Federal Reserve in an overnight basis. All right. Now, how does that affect mortgages? All right. Mortgages, on the other hand, track the 10-year treasury rate. Changes to the federal funds rate might or might not move the rate on a 10-year treasury bonds, which are also issued by the government and take a decade for them to mature. So not necessarily when the Fed raises the rate, does the interest rates on mortgages increase. It's not always the case. And sometimes I think the last increase, it caused it to go down. So how is higher interest rates? What did it really do? All right. So it basically affects the buyer's purchase power, right? That get affected. So you might be qualified for 400,000, but a rate increase could drop you back down to 380, 390, somewhere around there. I'm just giving an example. Not everything is set in stone. It's by case basis. The amount of purchase price decreases. It also slows the rate of home sales, right? Because when it's a rate increase, people they get wet feet. I'm going to hold off. So it's less people out there trying to shop and trying to buy that house. What does that do? It causes the homeowner, the sellers, to lower their price because they still want the home to sell. It's just that now the market has shifted and the power is no longer in the seller's hands in many cases. All right. It also lowers the amount of mortgage applications. People don't want to get a mortgage. All right. Again, we talked about what influences mortgage rates. Fixed mortgage rates are tied to a 10-year treasury bond, to a treasury rate, rather. When that rate goes up, the popular 30-year fixed rate mortgage tends to do the same, or vice versa. Rates for fixed mortgages are also influenced by other factors, such as supply and demand, right? So right now we're in that situation over the last few years about supply and demand. The supply is low, the demand is high. When mortgage lenders have too much business, they raise rates to decrease the demand. Yes, that sounds weird, strange. Kind of doesn't make sense, but it makes sense in their world. All right. So when business is light, they tend to cut rates to attract more customers. All right. So if rates go up, customers go down, as you see, follow the trend. The rates will come back down to then get some customers. All right. This all can be found on this bankrate.com, mortgages, Federal Reserve. You can go to that link and find that information. All right. So let's talk about historical rates. All right. So this is where I'm going to show you that what the news is saying is not accurate. Okay. So the news is saying that 6.1, 6.2 is high. All right. It's not high. I can point out for you around this time or so, I purchased a residential home for my family. It was for our family. And our rate was 6.1 or 6.2, somewhere around there. I got to look at the paperwork. It wasn't high. It was considered low back then. And this is when everybody, if you remember on the news, was everybody's buying a house. Everybody's buying a house. I mean, houses was flying off the shelves. Stuff was being done that was illegal in many senses because they were giving people mortgages that should never qualify. Okay. So that was that period. Okay. Then during 2008, it was a crash. The crash was in results from those poor banking practices to get everybody to buy homes. All right. Just to give you a history of what was happening in the real estate market and where we are today. The difference is today is people have a lot of equity in their houses, which means they have a lot of cash that's available because the appreciation went up so fast. And they were paying down their mortgages. Now, I want you to be educated, totally educated to make educated decisions. All right, so this was an article that came out for a recap of the Fed's rate hike and Powell's comments on the outlook for future increases. So they already said that they're going to raise the rate again. All right, so what does that mean? You raise the rate, it may or may not affect mortgages, right? Because you're going to only push that to so far. All right. But what does that mean for rentals? All right. It's very simple. If you're renting, right, the landlords of these rentals, they keep abreast to this. One of the reasons why they keep track of this, they have to charge the market rate in order for that property to be evaluated for the top dollar. So if you're charging below the market rate, the property won't be assessed at its true value, what it's really worth. So being a landlord, you are likely to be impacted by interest rate hikes. You need to know that with a higher interest rate, you can make more money from the rental units. However, this also means that you will be more expensive to borrow money for other investments in your portfolio. All right. Due to the rise in federal interest rates, the banks now have a higher cost of credit. All right. They'll pass that on to the consumer, such as landlords who want to take out big loans, including mortgages. Okay. So I want you to understand. Now, the average rent in the United States today is now $2,000. So I like math. I track everything. I'm a data guy by trade, computer guy. So 2,000 times 12, that's $24,000 for the month. You times that by 10 years, you're at 240, of course. You times that to 24,000 by 30 years, you're at 720. Now at 720,000, you could purchase a home. Now, the crazy thing about that is the rent will never stay at 24,000 or $2,000 for the year. For the month, it will always increase. All right. So that number will grow exponentially. All right. Rent will always increase. All right. You don't receive any tax deductions available to renters. No down payment assistance is available to renters for sure. And at 720,000, you could have purchased a home and paid it off, right? But you did because you're doing it for your landlord. So the landlord is benefiting from you making payments. Hopefully you'll understand you want to change that. You don't want to stay in that too long. Okay. Oh, also, let's jump back to this chart. The average since 1991 for mortgage rates is 7.76. That's the average. Today, we haven't even reached that average. Okay. So now that you know the average, now you learned the average interest rate over the last 30 years is 7.76%. Okay, so I asked this question to you. Are the rates truly high, or are you being told that they're high? Hopefully you see where I'm going with this. You're being told that they're high, right? Because they don't want you to buy a house. All right. This is being projected from the top going on down to the bottom. Now, I'm going to teach you something that has to do with the stock market. So there's a thing in the stock market world that they call hedging. So hedging is simply this. You have something that's going to go up and you use another product that's going to go up with it, and it should outpace what's going up. In this example, we're using home prices as inflation, as an inflation hedge. Home price appreciation has come close to or outpaced inflation in each of the last 5 decades. This data doesn't lie. This data was sourced by the National Association of Realtors and the Bureau of Labor Statistics. I apologize. I had a long day today. But as you see, 1970, it was 9.9, outpaced consumer prices by 7.1%. In the 80s, it was kind of even almost, right? In the 90s, it was a shift towards home prices, 4.1%. And 2000, the consumer prices outweighed it, right? So that beat it out. But look at 2010 to 2020 to 2021, 4.9 to 1.8%, 12% to 3%. So this is where we say, buy your home and you'll protect your money, basically, because the home values are going to outpace the inflation. Investors understand that very clearly. And I would talk about something later that investors do and how we think as investors. Okay, what can you do regarding the interest rates? It's very simple. When the market shifts, now is the time that the power goes back to the buyer, because it's incentives that are now given to help the buyer purchase the home. This was the way it was before the market shifted to a seller's market. So the markets will always turn and twist and do all that. I like it. I love it. I like to teach. So what we now do is negotiate seller's assistance from the seller, and that will offset the closing costs, right? Lenders will offer closing cost assistance from some mortgage companies. They will offer it, and from some banks they will. I'll also show you another thing that they will do too in a later slide. All right, now you take that money that you saved on the closing costs, right? And now you can work with your lender to buy down the rate. What is buying down the rate? It's simply a buy down is a way for the borrower to obtain a lower interest rate by paying discount points at closing. So the way it works, if you pay 1%, you don't get a 1% discount. You get 0.225 or 0.50. So you get some kind of discount that will then save you money and take it from you. 0.25, 0.50, it will save you a nice chunk of money. All right, so things to think about that amount to money. All right, now currently, if you can get it pre-approved, I would say get pre-approved, right? And you want to find out this from, a neutral mortgage lender, from probably like a bank or a mortgage company. This is what we do know. The Federal Reserve has already said that they're going to raise the rate again, somewhere between now and end of the year. The Fed policies are normally temporary measures to bring down inflation. Once inflation goes down, then they get control, and then now we can get back to, a different sense of business. All right. Now, this is what you do know, though. And if you didn't know, I'm telling you right now, you can deduct your home mortgage interest on the first $750,000. If you're jointly married and you're filing separately, it's $375 of the mortgage debt. Check with a tax accountant. Check with your tax professional on this information where you can save. The IRS provides several tax breaks also to make home ownership more affordable. This has always been the big incentive for people to buy. Another thing is this: common tax deductions include those for mortgage interest, mortgage points, and private mortgage insurance. All right. Now, tax credits, right? This is very important for all you first time. For all you guys that never have ever owned a home, this is very, very key. So, when you never owned a home at all, tax credits are available for qualified first-time home buyers and homeowners who invest in energy improvements like solar panels and energy-efficient windows. So if you're buying a home and you invest in that, then you get the tax credit if you own one previously. All right, and this all can be found here. This is where this information was pulled from. Now, also, the big behemoth in the room, because the news is bombarding you with a whole bunch of this information on a daily basis. So they set the tone here. So if a recession did happen, right? If they announced we're in a recession, I think we're in one already, because there's a slowdown of spending, because food, gas, and other things just went up so much that people don't have that extra money to be spending on other parts of the economy. But if a recession happens, what does that mean for mortgage rates? So mortgage rates in the last recession, from peak to right on through, from the 80s, it decreased. 81, it decreased. 91, it decreased. 2001, it decreased. 2008, it decreased. In 2020. Why is that? Because at that point, mortgages aren't being applied for. So to hold together the market, and I'll explain, the real estate market is the biggest market in the United States, out of all industries. So they'll incentivize people to get mortgages. Also, this is a strategy, and we'll go over about it right now. So financing strategies to think about. If the rate goes down after you purchase the home, this is the time when you can refinance into a lower rate. It's that simple. And typically it doesn't cost, anything to do so. They'll package it together so it doesn't cost you anything out of pocket. In some cases, you get a check back. Just giving you a tip. just to get you educated and let you know that this is one way that you can get around paying a higher rate. You refinance into a lower one, but you cannot renegotiate the purchase price of the house. So this is key. Right now, houses aren't going to move as fast in many cases, so you get a little bit of leverage. The great looking houses, though, we're kind of tracking that to see how that's going, because some of those are going to continue prior to go. Now, let's talk about what lenders will do with attractive financing. This is one example. Okay, 100% financing on a 30-year fixed mortgage. No down payment, no mortgage insurance, 80% of the medium area income. One caveat that you must be aware of is that this loan, you need a 700 minimum credit score. It's for her first-time home buyers only. They also have another one that's a 10 in one arm. I just haven't had the chance. It just came out today to update the slide. I'll update it now and then plug this in. So let's talk about the real estate market in Delaware. And now I'm going to educate you because it's national real estate and then it's local real estate. All right. So here's the raw numbers, and this is where you're going to see supply and demand come into play. All right. So in Newcastle County, which is the county that goes from Pennsylvania on down to right near Smyrna, midway, a little bit below the state. Half of Smyrna is Newcastle, and the other half is Kent County. Just to give you a scope of Delaware. Now, Kent County numbers is going to be different, and I didn't include it in the slide. And I'm thinking now maybe I should, but I'll update that a little bit later because it took me a while to put all this together with a whole bunch of other stuff that's going on in real estate. All right, so, but I love my job. I get to teach. I get to help people. I mean, I couldn't ask for much more. All right, so let's break this down. The median sales price in Newcastle County in quarter number 4 in 2019, right before the pandemic, the median price was $242. And the reason why that stood out to me because it went from like 220ish or so, 230 maybe, but it went up in 1 year by 6.1%. The average sales price is $265,000, right? That was the average sales price. That was up from 1 year ago at 8.3%. Percentage of the original price versus what was received, 96.3. I want you to pay attention to these numbers because these numbers are key and it's going to paint a picture for you so you can understand. All right, home sales was 1,141. That was down. I'm going to say down 35.9%, almost 36. Now, this is interesting, and this is what makes this period of time very strange. Now, closed sales was 1721. That was up 0.1.7%. Now, this is the key factor that every realtor focuses on, and we pay attention to it. Month worth of supply. What does this mean? This is the amount before we run out and be at 0 homes to sell on the market. 1.9%. I mean 1.9. It was down 34.5%. Now, I'm going to tell you what a normal market looks like. That number is normally 6. Average days was down because it only took 49 days for a house to sell. All right. Now, I want you to look at this, right? This is 2017, 2018, and then 2019. So it's kind of holding in there for closed sales, right? But this is where it gets off. So what happened to the supply of homes? What is going on with the homes for sale? It dropped. Why did it drop in 2019 so much? What was the factors that was causing it to drop? The rates got low in 2020, right? Which is interesting. And 2021. All right. So look at how the median price of homes jumped up, though. This is where you start to see supply and demand. And you start to see it run away, right? And now you're going to get a picture of why does the Fed want to slow this down? Because this is getting too high. So it's 270, 500. That's the medium sales price. All right, changed by 11.8%. The average sales price was $297,208, which went up by 12.2%. Now, I want you to pay attention. The percentage of the original price that was received, 99.6%. We're almost at 100% of the asking price, right? And you're starting to see where whatever they put up, the price, that's what the people are going to pay. But I want you to take note. The amount of homes for sale dropped to 550. So in the fourth quarter, that's the fourth quarter. That wasn't for the whole year. All right. But we measure things by quarters because at any given time, look at the month supply, 0.9. That's low. That's the lowest we've ever seen in history. The closed sales, 2113, which is so interesting for us to be so low of houses for sale compared to the ones that closed. All right. And average days for the property to be marketed, it went down by negative 44.4%. All right. Now let's keep it moving. All right. Again, 2021. Now we're in the heat of the pandemic. All right. So the price went up again by 6.7%. 290. The average sales price was 320. Up again by 7.9%. But look at that third line. Percentage of original price received, 100.2. So this is where we put a house up for sale. Excuse me. Whatever the price is, people are going to pay 100% because this is what's driving it. Is that right there? That number right there, 539 for sale. Month works of supply, 0.9 the previous year to 0.8. Days on market, it dropped again faster, right? So everything is running rapid and everything is in line with houses. So you had gas prices, 2022, you had food, you're going to have energy costs. That's going to cost more this winter because this summer, everyone used their air conditioning because we had a really hot summer. Now, this article is written. This is a popular paper in Delaware. This is like the main paper. So the median sales price for a single home in Newcastle County during November was $355,000. That is insane. The appreciation of homes, how rapidly it's going up. All right. So the number of homes rose by 5.1 from the year earlier. This is where if you bought a home in this period, it went up in value by 16.8%. I'm an investor. I like to invest money. I like to grow my money. And that's a surefire bet to put your money into buying a house. It's one of the best ways to increase your money, especially during inflation. All right. Because see, the dollars is losing the amount of buying power, but the house is going up in value. It's like a win-win when you buy the house, right? So now going forward, this data was taken and said home prices are predicted, and a projection can change. I just want you to know that. But it was predicted to go up by 7% next year. Before it was double digits, right? But if it goes up by 7%, that's equity in your bank. Like you're going to get equity from your house. All right. Let's talk about your future housing plans because this is important to help you with making a solid decision. All right. If you're not planning on moving in the next 5 years, you may want to purchase a home because you can benefit from the equity. Like I love equity. A lot of my decisions when I'm making certain decisions, it has to do with equity because that's future income, that's future growth. Stock purchases, equity, even what I'm doing for business. I took an equity position. Equity is everything in my work because equity is like real money, future money. All right. If your landlord is planning on increasing your rent, you might think about taking advantage of buying a house and instead of your landlord benefiting from the appreciation and the equity, you can. All right. And this will go on probably forever, because once I figured out everything when I was young, I didn't learn always buy a house. I might move to another city. I might rent for 1 year to get the scope of where I want to live. And then that next year I would buy. All right. So buying in a few years from now will most likely cost you more to purchase if you do that. So you might want to look at like purchasing now. All right. Now, the goal. This is what I teach all my clients. The goal is to purchase a home because equity will follow. Equity mostly goes up in all the great areas. Even if you bought a home that's not your dream home, the rental market will rent it for you and pay you more money than what your mortgage is. And that's the beautiful thing. So you can go laterally from that home up to another home, because the lender can actually count the income that you're making off the rental and include it with your income to then purchase another home. So that's just another strategy, just to drop a little jewel there to you. All right. Now, I know on the news, they're going to preach and teach and say, well, if you buy a house now and then the market shifts, you're going to be upside down. All right. You're only upside down if you have to sell. I used to love when they were saying that back in 2008. Like, the market is dying. The market is crashing. They keep saying that now. There's a difference between 2008 and 2009 and where we're at right now. Many more people have equity in their homes. The loans that they took out are way more stable, and you definitely qualify, right? Now, the other strategy and the goal should be rates will continue to go up and rates will go down throughout history. So purchasing now, you can save, right? Purchasing, taking the plan to wait later on, you don't know if they're going to go up, go down. But if you know that the appreciation for the house itself is going to go up, then you might as well benefit from getting that house now, and then planning out next year, whatever may happen if the rates go down. All right. People purchase rates when they were 13%. The goal was then to own a home. And that's what they did. And they bought. And the world didn't end, and the price of the house was not as high as it is now. So the prices are going to come down. You're going to get that strategy if you go with getting seller assist. And there's going to be many more programs and many more attractive financing to help keeping the market to move along. This is the way it works. All right. So another thing, the goal, right? For many investors, the investors understand and focus on equity. And their other word is cash flow. So home buyers need to take on that mindset instead of following the mindset that's being divvied down to you from the news. Because the news don't want you to buy, right? Because they want to turn, the powers that be may want to turn those into rentals. So then you rent forever. If you want to see something that's interesting, go on YouTube, go to 60 Minutes, and look for a segment that talked about millennials and those institutional buyers, these companies that want them to just rent and not own anything. That's the ultimate plan from many of these companies. They want to turn them all into rentals so that you can't buy it. So buying it, you will benefit from it. I can almost guarantee you that. All right. So if you have any questions and you want to, just talk, give me a call at 888-543-4829 and extension 323. And we can have a nice talk, and I can teach you about lending. If you got a pre-approval and the pre-approval was low for whatever reason, we can have what's called a second opinion and see if that lender can then approve you for a higher amount, something that's more attractable and keep you within your budget. All right. So share this video with as many people, because I want people to be educated and really learn. how this really works. If I was if I had to buy all over again, I would buy. I mean, I bought at 6.1, 6.2, waited for the rates to go down, and then I refinanced. So I would go with that strategy again. I would not change my strategy. All right. So you guys take care. God bless you. And hopefully you like this video. So like it. Hopefully it was useful. So like it and share it. Hopefully you want me to do more videos. All right. You guys take care. Bye.